buckle up. While every crypto influencer on Twitter is screaming about the next 100x meme coin, the most powerful financial institution on earth just made a move that's about to reshape everything we know about money itself. I'm talking about BlackRock, the $12.5 trillion asset management leviathan that doesn't just participate in markets, they literally architect them. And here's the kicker that'll blow your mind. They're not betting on another speculative token for the future of finance. The infrastructure they are quietly assembling points to one protocol that's been systematically building institutional rails for over a decade. What you are about to discover will completely shatter your understanding of where institutional money is really flowing and why most investors are looking in completely the wrong direction. According to McKinsey & Company's latest institutional research, the tokenized asset market exploded from $3.9 billion in 2025 to projected $12.8 billion by 2032. That's an 18.3% compound annual growth rate. That's making traditional finance executives lose sleep. But here's where it gets wild. BlackRock CEO Larry Fink didn't just call tokenization the most disruptive innovation since ETFs. Internal strategy documents reveal BlackRock's four-stage digital asset roadmap that's already in motion. Stage 1 focused on tokenized money market funds, and they've absolutely crushed it. Their Budo fund is sitting at $2.9 billion in assets under management, capturing 30% of the entire tokenized U.S. Treasury bond market within months of launch. Stage 2 targets tokenized bonds and equities through regulated custodians. Stage 3 expands into tokenized real estate and alternative assets. But Stage 4, that's where things get absolutely insane. Programmable financial instruments and automated market-making protocols designed specifically for institutional portfolios. But Stage 4, that's where things get absolutely insane. Programmable financial instruments and automated market-making protocols designed specifically for institutional portfolios. Think about this. Federal Reserve data indicates that traditional cross-border settlement ties up over $31 billion annually in liquidity drag. Every day that money sits in correspondent banking limbo is capital that could be deployed elsewhere. BlackRock's tokenization strategy isn't just about efficiency gains, it's about unlocking trillions of dollars trapped in antiquated settlement systems. The $194 billion reality check that changes everything. Here's the mind-blowing data that most investors completely missed. XRP's current market capitalization of $194 billion, when adjusted for velocity using Chain Science's methodology, reveals a realized capitalization of just $60.6 billion. What does this mean? Institutional inflows of $5.82 billion to $11.64 billion. The projected range for XRP ETF, first-year flows would represent 9.6% to 19.2% of velocity-adjusted market cap. That's absolutely staggering. Compare that to Bitcoin ETFs, which attracted $19 billion in their first year but only represented 3.8% of Bitcoin's velocity-adjusted capitalization. The implications are off the charts. XRP's infrastructure-focused tokenomics could amplify institutional impact by 250% compared to speculative assets. But wait, there's more. Treasury Department sources confirm that ISO 20022 messaging standards become mandatory for all major financial institutions by November 2025. Here's a twist that nobody's talking about. XRPL natively supports ISO 20022 data formats, while most other protocols require costly third-party integrations. Central bank pilot programs demonstrate that ISO 20022-enabled corridors could drive a 25 to 40% increase in cross-border liquidity transactions by 2026. Let me break this down with cold, hard facts that'll make your head spin. While Ethereum struggles with 15 transactions per second and Bitcoin crawls at 7 TPS, XRP Ledger processes 1,500 transactions per second with settlement finality in under 4 seconds. Transaction costs? a microscopic $0.0002 per transfer, regardless of volume. These aren't marketing numbers, these are production metrics from a network processing over 70 million ledgers since 2012. Here's what'll shock you. RippleNet now encompasses over 300 financial institution partners across 45 countries, with 40% actively using XRP for cross-border settlement. We're talking about real institutions processing real money. The numbers don't lie. Annual ODL flows surpassed $15 billion in 2024, representing a 32% year-over-year surge. Asia-Pacific accounts for 56% of ODL volume, driven by USD Philippine Peso and USD Japanese Yen corridors processing billions annually. This isn't speculation, this is institutional adoption happening right now, at scale. Central bank validation that proves everything. IMF working papers reveal that Ripple's CBDC platform is under pilot in 10 countries, including Bhutan's Royal Monetary Authority and Palau's Climate-Aligned Digital Currency Initiative. The Bank for International Settlements Project Dunbar specifically tested XRPL's capabilities for multi-CBDC interoperability across Australia, Malaysia, Singapore, and South Africa. Results? Settlement times collapsed from days to minutes, with 90% reductions in reconciliation errors. Central bank digital currencies represent the ultimate validation of blockchain infrastructure. By mid-2025, 49 countries were running active CBDC pilots, with 11 live retail systems already launched. These aren't experiments anymore. They're production deployments requiring enterprise-grade rails. China's ECNY processed over 2 trillion yen in transactions. Nigeria's e-Naira hit $50 million in daily volume. The velocity is breathtaking, and guess which protocol is powering the interoperability between these systems? That's right, XRP ledger infrastructure. The real-world asset revolution on XRPL. This changes everything when you realize what's already happening on-chain. Ondo Finance's tokenized U.S. Treasury bills OUSG on XRPL reached $670 million in total value locked by July 2025. These aren't synthetic derivatives, they're actual BlackRock money market fund shares tokenized for 24/7's minting and redemption using Ripple's RLUSD stablecoin. The beauty of this integration? Atomic settlement where treasury units are minted or burned instantaneously upon RLUSD transfers. Institutional investors can realize overnight funding for collateralized loans without capital inefficiencies or multi-day delays. Permissioned accessibility ensures only accredited institutions interact with tokens while maintaining blockchain transparency. The August 2025 SEC settlement definitively clarified that XRP's programmatic sales constitute non-securities transactions. This regulatory clarity unlocked major U.S. exchanges to relist XRP, driving 208% volume surges and 17% institutional inflow increases within 30 days. Basel III compliance standards require banks to maintain specific capital ratios for cross-border exposures. XRP's role as a bridge asset allows financial institutions to reduce regulatory capital requirements by eliminating pre-funded foreign currency reserves. One European bank reduced Latin America corridor capital charges by 45% using ODL, freeing regulatory capital for lending operations. Prudential regulations demand that asset managers demonstrate robust risk management for digital asset exposure. BlackRock's Aladdin platform, after integrating crypto asset modules, now supports multi-factor models incorporating XRP's network effects, regulatory milestones, and institutional adoption metrics. Here's your light bulb moment. Network effects in financial infrastructure create winner-take-all dynamics. As more corridors activate on RippleNet, liquidity depth increases exponentially. Each new bank, payment provider, or central bank that integrates creates value for all existing participants through improved foreign exchange liquidity and reduced settlement risk. Market maker participation has deepened XRP liquidity pools substantially. Jump Trading, Susquehanna, and other institutional trading firms provide order book depth supporting multi-billion-dollar ODL flows. Between 2021 to 2023, Ripple purchased over $2.5 billion of XRP on secondary markets, specifically to enhance corridor liquidity. That's institutional capital deployment focused on utility, not speculation. Whale accumulation patterns reveal sophisticated positioning ahead of institutional adoption. Analytics show addresses holding over 10 million XRP increased positions by 900 million tokens within 48-hour windows during mid-2025. This contrasts with typical pre-launch profit-taking behaviors, suggesting confidence in continued appreciation under institutional demand scenarios. The macroeconomic tailwinds driving everything? And here's where it gets wild with the macro picture. 10-year Treasury yields averaging 2.9% through 2025's first half. Yield-seeking institutional investors are diversifying into alternative assets. A Greenwich Associates survey found 42% of institutions view crypto assets as viable inflation hedges, but only compliant, utility-focused protocols pass their due diligence protocols. The Federal Reserve's quantitative tightening measures have been gradual, sustaining market liquidity while institutions seek yield optimization mechanisms. XRP's fixed 100 billion token supply, coupled with transparent escrow release schedules, contrasts favorably with potential CBDC inflation risks from discretionary issuance policies. Cross-currency settlement efficiency becomes critical as central banks explore programmable monetary policies. The European Central Bank's digital euro framework emphasizes interoperability with existing payment rails, exactly the infrastructure XRP provides through RippleNet's correspondent banking alternatives. The coming systemic repricing. The implications are staggering when you connect all these dots. Bloomberg's Eric Balchunas estimates 95% probability for XRP ETF approval before year-end 2025. Polymarket odds consistently trade above 90% despite regulatory review extensions. Franklin Templeton's filing represents the institutional validation BlackRock has been waiting for. Scenario analyses by investment banks suggest capturing just 5% of the $150 trillion global cross-border payment market would require XRP's market capitalization expansion by an order of magnitude. Risk-adjusted return profiles incorporating XRP's utility value proposition show enhanced Sharpe ratios of 15 to 20% over 3-year horizons when added to diversified institutional portfolios. Multi-chain integrations via Wormhole extend XRPL assets into Ethereum, Solana, Avalanche, and beyond, creating hub and spoke interoperability models. Over $2.3 billion worth of XRP has been locked in cross-chain bridges, representing 1.18% of circulating supply, generating 6.4% annualized yields through DeFi deployment. What you're about to see will shock you. Tokenized asset volumes on XRPL surpassed $4.7 billion by August 2025, with the majority representing USD stablecoins and tokenized securities. This validates XRPL's design as enterprise liquidity infrastructure rather than speculative trading venues. Atomic settlement capabilities eliminate counterparty risk through protocol-level escrow mechanisms. Unlike Ethereum smart contract layers, XRPL provides native tokenization features with built-in compliance controls, exactly what institutional asset managers require for regulated product deployment. The World Economic Forum reports that of $255 trillion in marketable securities, only $28.6 trillion actively serve as collateral. Tokenization can mobilize even a fraction of this for global liquidity management. Successful implementations at Euroclear and the World Gold Council for tokenized gold and sovereign bonds illustrate. Smash that subscribe button and hit the notification bell, because the crypto revolution is accelerating faster than anyone predicted, and you definitely don't want to miss what happens when institutional money discovers the altcoin opportunities that smart money has been accumulating for months. Industry insiders are calling this the silent transformation of global finance. While retail traders chase meme coins and social media narratives, the world's most sophisticated financial institutions are methodically integrating XRP into the backbone of tomorrow's monetary system. This isn't disruption the way crypto originally imagined. It's integration, evolution, optimization. The financial system isn't being replaced. It's being upgraded with programmable, transparent, efficient rails that happen to run on XRP infrastructure. Central bank partnerships, regulatory clarity, institutional custody solutions, and enterprise-grade performance metrics have converged to position XRP not as another cryptocurrency, but as the liquidity protocol powering the next generation of global finance. Your strategic positioning moment. So there you have it, the most comprehensive analysis of why BlackRock's tokenization strategy points directly toward XRP infrastructure that most investors are still completely missing. This isn't about hype or speculation. This is about institutional capital deployment strategies that are reshaping financial market architecture from the inside out. The convergence of $2.9 billion in BlackRock's BUIDL fund, $670 million in tokenized treasuries on XRPL, $15 billion in annual ODL flows, 300 financial institution partnerships, 10 central bank CBDC pilots, and 95% ETF approval probability creates an unprecedented institutional adoption scenario. If this deep dive into institutional finance opened your eyes to what's really happening behind the headlines, then smash that like button and help push this analysis to more people who deserve to know what the institutions already see coming. Drop a comment below. Are we witnessing the quiet revolution that transforms global finance, or just another crypto cycle? I want to hear your take. Subscribe and hit that notification bell because this is just the beginning of our institutional finance coverage. Share this with anyone who still thinks XRP is just another altcoin. They need to see how the world's biggest asset manager is quietly building the future of money itself. The transformation is happening right now. The data is overwhelming, the institutional adoption is undeniable. Stay ahead of it. I'll see you in the next one.